Right, jet setters. I haven't posted anything for a few days. I was off on holidays again. It's that time of year, but it's been going on right. Um, I guess first thing, let me tell you what I've been doing. Um, I think where I left it last time, like I had some shorts that I bought back to square up, and I've gone long the Aussie Spy. My average is about 67.23. Look at my notes, 67.23, just down here. There was a day when when the toilet really flushed. This was a real clanger of I reckon it was margin called. Our market just dropped like almost 300 points. It really just dropped like a stone. Or is it? Yeah, it's like 276 points. It just dropped like a stone. That was a liquidity event, and I've seen them before. Particularly trading options. When I ran the options books, you see them a lot. And when I was running books during, Asian crisis, GFC, 9/11, .com, Argentine debt crisis, all these kind of things I've done. You get a feel for them. That liquidity was the time to catch the knife. So I caught the knife. And I guess it coincided also when I looked at it, it just totally plummeted below that level of pre-GFC high, and then there's another level in here. You can see a bit on the line where I've been looking at that 6,800 level as a level to buy and re-establish. I've had a core long-term position for like it's close to 20 years, right? In futures that I just roll, and I got out of it here right, when it was falling down, made a whole lot of money on the way back, gave a lot of it on the way back, right, because I was staying short, because it was a hedge against my core long-term portfolio. So I've been looking for a good level to get it back, and ideally looking for here where I had gotten out of it. 68.50 was the level that I had in mind, which is here. So I was pretty happy about that. I'm still a little bit cautious though. There is this big gap in here that I see it coming back to, but at least in the Aussie market, you can see that it's come back to a pretty good technical level. Like that's the 23 retracement, as well as this previous level where you can see where there's a lot of resistance, a lot of support, a lot of resistance, retest support came through. That's a pretty good level. So I'm not long to the gunnels on it, but I have re-established a core long-term position which I'll hold for a while. So that's worked out okay. On the other side of the coin, I've got like I've gone short. I've stayed short some of the S&P, and that's more just to play the spread because the Aussie market oversold compared to the US. So when I picked up a lot of that Aussie position, I thought I'm just going to do a short, like a little bit of it on the other side of the coin to play the spread. It doesn't totally hedge it, but it just puts a bit of that spread position on. You can see the US market, obviously, like it has way outperformed the Australian share market. And is nowhere near its pre-COVID highs, whereas the Australian market is back down here. So I'm maintaining that short just for a little while, and I've got in mind this level here, 45.50, where I'd get out of it. You can see it didn't quite get that 23 retracement, but it came close. Depending on where you put these. That's like a weekly low, so I just wash out some of that noise there. The US market didn't look anywhere near as messy as the Australian market, so I suspect this hasn't had the big clean out yet. As far as where it's retraced to, it's sort of like bang on like the 50% retracement. Look at that. Where it's come back to. So that coincides, and I guess you can, depending on where you want to draw it, right? I guess you could draw it there, right? Call it a 38, whatever. I think this level is more important to see what happens when it gets here. I don't think it's going to break through, to be honest. I think there's too much damage that's being done. I think this is dumb money. I'm pretty bearish. This. There's a few bigger reasons why. This is, when you look back, let me just get rid of this for a moment. This is the whole move from the GFC, and it's pretty interesting how it's kind of moved, right? This whole move, right, has been very, very technical. I'm just going to put on a monthly to make it a little bit clearer. So when we take it, we just wash out that noise there. From this first leg, to that high, then back again. You can see it stalled at the 161 level. And we go to this level here, and this one. Right. You can see it stalled like here. That was the pre-COVID high, right on the ding-dong of the 1-to-1. And again, it's stalled up here, right, at the twice that wavelength. If you move it like to that low, it is like literally like right on the ding-dong of that. Basically, that leg is twice this leg. The scale's logarithmic, right? If you don't understand logarithmic scales, then do some Googling, right? And even like here, to that low there, that's another 1-to-1, it's in that leg to that leg is 1-to-1. So it's when you, and these are significant highs, there, 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 and there, and they've all corresponded to a reasonable pullback, to new highs, right? But you can see how it is uncanny, major high, good pullback to a new high that reached a good level of equality here. Another high where it stalled at, came back to the low, stalled at a major, wave equality. There to here, came back, stalled at a major high equality. So that says that this, right, is a very good place for it to stall, right? So that's that. The next point, again, the reasons why I'm bearish is that is just on given the runs on the board, it's a level for it to pull back to, right? Now here, so go from here, hey, this pulled back to the 38. Right? Even this little one here pulled back to the 38. This one here pulled back to the 23. It's further along the time scale, so that kind of makes sense that it's not as deep. This one, pull back. What did this one go to? That one pulled back to the 23. This one, guess on whatever measure, pulls back to the 38. This one, even if it goes to the 23, that's 3,800. I guess let's take a look at some of these legs individually. That one pulled back to the 23 on that leg. Okay, what about from here? What did this one go to? That was a 61 or a 78, very deep, right? On this one, 50 retracement. They're big retracements, right? And this one, it's only just made the smallest one, right? That one, to me, and given that the acceleration here, that one to me looks pretty magnetic. So the timing in terms of having reached a major top fits in when you look at the overall action of these waves, and the pullback so far doesn't even touch the sides, And again, when we look at the channel, the trend, depending on where we want to draw it, let's do it to these closes, hey? You know, it's nowhere near, right? It's just over the top of the channel, and it's got a long way potentially to go to reach the bottom. You know, that's another 20%, at least. So that's why for the Aussie, I'm comfortable being long that one. It is quite a different market to the US. Well, the US market, I'm slightly short. That's that one. Just a quick look at the Russell, which has been, you know, the canary in the coal mine. You can see it has got a beautiful big gap that it's just rolling over into. These, on a technical thing, these are some, you know, they talk about setups, price, like setup. I hate that term, but it is kind of true. Where you see something have a big, you know, just non-stop leg up and then a pause, they roll over, right? This one has got more to go. And we can see it in one of my favourite ones, which is the 2-year bonds. So I've still been short these 2-year bonds. That's been a beautiful little sleeper of a trade. Look at that, you know. That is exactly the same pattern, right, that we've seen in the Russell, where you have a big stab up one direction, has a stall, and it comes back and it fills it all, right? Let's look at the Russell again, right? Wherever it is. Right? Okay, you see what I mean, right? It's done that same thing, and it's got a fair way to go. You know, that would be another 9%, and that takes it down to a 50% retracement, right, of the move post-COVID, and it actually takes it back to pre-COVID high. Pretty good technical level for it to come back to. What else is it we're looking at? The other one. This is a this is a good little trade I've put on, which I hope will come good. Be another one of these sleepers. Is the German bonds. So these are the 10-year bonds. They trade at basically, it's a 0% yield, and we can see that these ones that take off the log things because of the bonds. You know, in my mind, this has started to break and roll over. It's going back to 2006. And overnight, just on some European inflation numbers, it's just started to have a little leg down. I think when this breaks, it could really have quite a correction. And one of the reasons I went short this is these are 10-year bonds at 0%, a little bit under. Their inflation is 5. It's AAA. Australia, for example, is AAA. Inflation's at 3.5, and our 10-year bonds are at 2. Right, so you've got 1.5 negative real interest rates over 10 years AAA Australia. In Europe, you've got 5% negative real interest rates 10 years AAA. So to me, this is one of those ones where I look and say that is compelling. It's up there with the 2-year notes. And as far as compelling trades, the interest rate markets, that's where I've seen compelling stuff lately. Here's that. This is yield rather than price, right? So it's upside down. That's that gap that we saw before, that we've seen the Russell do the other way, and that we saw on the price on the futures. This obviously yield. This is compelling value. You know, when it was down here, these record lows, it was only going to go one way. So that's the yields. That's the equity markets. On gold, been short gold. Similar thing. These patterns. This to me is pretty compelling. Value. And again, when you look at it compared to, let's compare it to the US 2 years. You know, we can see, let's just get gold back up here. I've looked at this before on some of the charts. Let's just get my ducks lined up. Get rid of that. Okay. Right. Okay. Back to 2001. Back there we go. That's just about lined up. Yeah. So we can see here that high there, right, corresponded with this low in there. All right. Let's line up a bit better. There we go. Yeah, so you can see a low in here in the yields corresponded with a high in that gold. When we see gold fell off, right, this is when these yields just start to tick up. You see it clearly as well on the 10 years. Here, like a high in those yields, right? That's like a low in the gold price. And as yields went down, gold went up. Right? So as yields went down here, right, gold went up. Okay, and you can see it here, right? When yields peaked here, right? Just that pause, little pause in here, right? That little pause in there corresponds to this little pause in here. And as they start to fall, what did gold do? Right, it ticked right up, and it hit a high on the lows. As interest rates then started to come up, right? It came down, hit like a comparative low here, and there's a bit more of a low there, right? We really need to look at the 10 years as well, right? Because it's a curve thing as well. Here, when rates started to come down, it kind of went up, right? To again another peak here, and rates bottomed down here, like 6, 7, 8, 9 points, and just about here, you can see when the 2 years just started to pick up here. That's where that little stick is that it started to fall down. Now, when we look at the 10 years, I should have a look at this as well at the time. I don't want to bore everyone. Let's line it up as well. Yeah, you can see how when the 10 years ticked up here, that's when gold started coming off. Here, 10 years, were coming off, and gold had just that little spike up there. So in here, there's been a bit of confusion between what's been happening with the shape of the curve, right? But again, you can see here, 10 years started to come down, gold went up, right? Here, it's not as clear as with the 10s as it is with the 2s, but a high in the price corresponding with a low in the yields. And here we can see as the 10 years start to tick up, gold fell off a cliff. So as we see this price action in the 2s and the 10s, we are going to see gold plummet. That's my hypothesis. What else? I've done a bit in the Aussie. I shortened the Aussie, squared up just before it hit this 70 level, big psychological level. It's having a little bit of a bounce back up close to 71. I still think it's probably on the way down, but it does depend on what's going on with the strengthening the dollar. And the strengthening the dollar, that really is, you've got to look at the euro, and the euro has really been having an interesting time of it here. Of late, down to like to 111-ish, that kind of territory. That's pretty punishing. And when you look at the euro on a long-term basis, you get this interesting trend here. Let's get it again. Oh, I don't think it's going to do it. That line's not going to do it. What are you doing to me, man? You're there. Yeah, so I just want to get my head around this technology. So that is going to be interesting to see what happens here. There's a few things going on technically, whether we've got like some kind of channel like this, I don't know, some kind of issue like this. This is where technical analysis is like reading tea leaves. It's just a bit ridiculous, but it's at an interesting juncture here to see what happens with the dollar index. I'm not going to do the dollar index now, running out of time, but look, that's it. Said the US markets, I'm still short them. I think that they've got really a very long way to fall, potentially. Their valuations are still very stretched. Yields are on the march. I wouldn't be surprised if the Fed did 50. I remember I was trading an options book back in 2001, and the Fed did They surprised the market with an intra-meeting move very early in January. Took everyone by surprise. I wouldn't be surprised if they try and get back on the front foot with a 50 move. You do see more people talking about that. I think that is definitely on the cards. That would give the market quite a shock. And I don't think the Fed is that worried about the market having a pretty healthy correction. Where we are now, we've had a good retracement. I think this move, this level here, at 4,500 is in play for it to test. I think the test is going to fail, and I think that there's been enough technical damage done that it's going to have a retest down here. There's a big gap here. I'm still looking for it to go down. That's how I'm positioned. Having said that, I'm long core in Aussie equities. I'm short Aussie 3-year bonds, the Aussie 10-year bonds, short the US 2-year bonds, now short the 10-year bonds, the euro, and short gold. So I've actually got quite a lot on at the moment. Look, that's about it. I'm going to do another video shortly because it's been a while between drinks anyway. I hope you've been doing all right. We'll catch you later. Okay, ciao.